Hey everybody, Cowboy here. We have a video today. It's a clip from our private session, but it's more of a basic concept. So I know usually the clips that I put up here have to do with concepts that are more of a beginner concept and they come from the Beginner Live Lab. However, I thought that this was a great opportunity to talk about spreads, how they work, how to avoid, or at least how we avoid, getting stopped out or having other issues. Remember that anything we say on this video is all intended as education, entertainment, not investment advice. Stick around. Afterwards, we'll show you how to find us and what we do and how we do it. All right, enjoy. So if I were taking trades, and I'm just doing New York time here, so if I was taking trades, I would look to exit those trades before, say, 4 o'clock EST. Which is an hour before market close. Because what happens at market close, especially at the New York close, doesn't happen elsewhere. Only at the New York close that I've seen, and right before the Sydney session opens, all of the trades get taken off. And part of the reason is that if you keep your trade on, then you have to pay a spread. And that's not a very big number for people like us, but it does add up. And the biggest thing is that you have so here's how a spread works, okay? And this is why it's a problem. If you look, and I'm zooming in like a lot right now, okay? So if you can see it on the screen, and it might be a little hard to see, but there's this red line on the top and this blue line on the bottom, and you notice the candle is in the middle of that. Okay, that's your spread.
Yep.
So the way it works, and I'll illustrate this, I'll build those lines. Okay, so we got the red line on the top. We got the blue line on the bottom, and that's blue enough. And then you have your candle, right? So in this case, it looks like this. All right, so and we'll give it a little wick. Why not? The John Wick here. All right, so the price of the candle, the actual price that you're looking at, like when you look at something, it's going to be right here in the middle. It's going to be this 108 dot. Let me zoom this in. Sorry, everybody. Let's make this so people can read the numbers. In this case, right in the middle where that candle is you can see it now in gray, 108.410. So this is the EUR USD. So it's the euro in terms of the dollar, which is $1.08 of a cent. Okay, but here's the problem. Let's just say that you want to do a market sell. Okay, you're gonna the people who are selling to you. I'm sorry, the people you're selling to, it's going to be lower than this midline price. So the price is officially 108.410, but the next order where people are willing to buy is going to be down at 108.396, which is about a pip below that, a half a pip. Okay. In this case, it's more because I'm doing an exaggerated example. So 108.4. So this is, it's like a whole pip. So basically, if you did a market sell, right, instead of getting this price in the middle, which we'll code yellow, instead of getting that price, if you did a market sell, then the next willing buyer is going to be lower than that, and you're going to lose a little bit of money. Now, let's just say you did a market buy. Let's say you were short and you wanted to exit. Well, the next person selling is going to be up here, which is a higher price than the midline price that you think that price is. And that's the spread, because this is the top, the red is the top of the order book, right? All the orders of people who are selling are above this line. So if you're buying, you got to go above this line because ain't nobody selling below that. And on the flip side of that, everybody who's buying is below this line. So if you're selling, you got to go below this line because ain't nobody buying above that. Okay, that's the spread. Well, at 5 p.m. EST, the spread goes like this. You see that? So instead of like, okay, you just had to go like a half a pip down, now you got to go 2 or 3 pips down. It's a big difference. When you're paying, if you do a standard lot, that you're losing $20 right there, right? And that's okay, $20, who cares? Well, here's the real problem with that, okay? The problem isn't so much the spread in, oh, I have to buy out or sell out, I'm going to lose the slippage. That can be a problem if you're entering trades at that time, but nobody enters trades at that time. Anybody who knows anything doesn't enter trades. Here's the problem, okay? So let's say that you are in a trade and the candles look like this. That's an ugly candle. I think there's a way to actually do this better. Give me 1 second. That's not it. That is not it. Shoot, where is that drawing? There's a way to draw this out that's easier than what I'm doing, but whatever. I'll just do it the old way. Okay, so, and you're in a long trade, and your stop loss is like right here. Okay, so let's say you entered way back here, and your stop loss is down here, right? And then your take profit is, way up here. You can't even see it. It's up. It's way up here. Okay, so that's a nice trade, right? So as you get down this low, and your stop loss is sitting right here, right at this blue line, right? Well, or the yellow line, I should say, which is good. We want it to be yellow right now. You're getting pretty close to your stop, right? But price is way up here. You're not going to stop out, right? That's where the price is. And at a normal time, the spread is going to look like this, right? So you're going to have just there's, it's not exactly the price that you're hoping, but it still is, it's not going to stop you out, right? That's your spread, right? See the blue and the red. See how it is like right there? Okay, so that's your spread. Well, here's the problem. 5 o'clock hits, spread goes like this. Like that. And then all of a sudden, all the people buying are below your stop loss and you get stopped out. Okay, so if you're going to trade around 5 o'clock, that's a problem because the spreads blow out. Because the buy orders that are willing to buy you out, they go below your price, or the opposite. It's the same problem as if you're on a short trade, right? So if you're in a short trade, right, this is your trade here, and let's just start over. So let's say you're in a short trade, and stop loss is way down here. All right, so okay, so and you're in profit, and then it goes against you a little bit, and then you're back into profit, and all of a sudden you kind of have a bad move, but you're okay, right? You're okay. You got your midpoint price, which is not the real price, but that's just what the number says. And then the real price is where you can buy or sell. The real price is based on the spread, and so that's going to look like this. You're going to be like a pip or two above, below, depending on the pair. Some pairs have wider spreads. The majors have tighter spreads, right? The 8 majors, but then you're weird, like the ruble versus the Swiss krona or whatever. I mean the Swedish krona. Like it's gonna have like a 20-point spread. Those are the exotics. But for now, you're okay. All right. Well, what happens at 5 o'clock is that all of the sell orders go way up here past your buy order, and then you get knocked out of your trade. So this is a big reason why people all exit around 5 o'clock, because of the spread blowing out. And there's a lot of things that happen financially. All the money has to get settled, so you get a lot of the there's a lot of reasons for that financial plumbing to occur. But in the end, if you're close to your stop out at 5 o'clock, you're in trouble. So a lot of people just exit the trades, or they plan their trade so that if it's like a swing trade, you can stay on, because you have huge, there's much more room between the trade and the stop loss in a swing trade. But a day trade, you need tight spreads, which is why day traders tend to stick to the 8 majors. If they go outside of the 8 majors, they're looking for there's still a tight spread on whatever they're trading, but they certainly are out before market close. Okay, so that's a lesson right there in how to handle like forex trading, market close, things like that. So that's something key. Valley Girl is asking. So we are live every weekday, 8:30 AM EST, giving out free content. Come check us out on YouTube. Come talk to us. Go over to the website. That's www.algofactory.tech. Again, www.algofactory.tech. And for a limited time promotional offer, we are giving out memberships at $49.99 a month. There's a ton that we're offering over there. Come see what that's about. Also, you can see our Twitter link. All the links are up on YouTube. Come talk to us on social media. See us on the live YouTube videos. We hope to see you soon.